Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Roster with Victory Fiduciary, and today is going to be our last video for 2020. So I can't believe that we're getting ready to finally ring in that new year. I know 2020 has been one for the books for many different reasons, and there are a lot of people who I know have endured a lot of different challenges and struggles, and so we've made it, we persevered, and many of us are ready to welcome in a new year. But before we get there, I wanted to be able to spend some time and kind of talk to you about the current state of the market that we see and kind of what we might be able to expect for the new year coming through. So we're going to talk about the strength of the market, relatively speaking. And so you know that I've made many different discussions talking about how we use relative strength to help us determine what are the best areas of the market that we should be investing in. Should we even be investing in the market right now? And we can tell that by checking the relative strength of equities, stocks versus bonds or cash. And there was a period of time this year where cash was actually stronger, had a stronger relative strength than equities. And so that's not the case right now. So equities are actually being very strong. And so what I'd like to do though is to kind of show you how relative strength, we talk about the fact all the time that the way that we invest, we use a math and rules-based process. And so I really wanted to show you, so this was not what I was planning on talking about today, but we had an investment committee meeting and we were talking about the overall relative strength of the market and some shifts that we've seen in the past couple days. And I thought, wow, this is actually a really neat demonstration of kind of how, we use math and rules to kind of understand what's happening within the market. And so up until December 22nd, so from November 30th to December 22nd, the funds that we have been, that we've had positions in have really just absolutely outperformed the market pretty remarkably, actually. And so if we look at the areas that we were invested in from November 30th through December 22nd, and these are looking at large cap funds, and then being compared against the S&P 500, that's what the SPX is. So if we looked at only funds in that area with relative strength that up until the 22nd had an RSI, or relative strength, of over 70, you can see, and these are using funds that we're actually invested in, overall returns of 14% versus what the S&P did at 1.81. So you can see those higher levels, that those funds that we're investing in with that relative strength absolutely outperform the market. Now, December 22nd through today, we began to see a pullback in some of those areas. And a pullback simply means just as it sounds. Typically, as you are at either all-time highs or close to those, the prices begin to kind of get some pressure and they pull back from those highs. So since December 22nd, those areas that we've been investing in with that high relative strength, they saw a negative return of negative 1.5, where the market was up 0.87. And so you may have been thinking to yourself, hey, like, what's going on? I'm hearing that the S&P had a positive day. Some of my funds are down negative. And so, and this really is a great picture as to what was actually happening. These funds had completely, they ran hot for a while. They were then a little overextended, and so they needed a couple of days to kind of pull back and almost like cool off. Because we know that when we get above 70, that's a very extended number. So typically, we don't hit 70 very often, and we typically won't stay there very long at all. We kind of almost have to come back down to a more normal number. And so then this chart here was just saying that on 12/22, funds that had an RSI, a relative strength of greater than 70, of them, only 15% of them were positive, while all along they'd been outperforming the market, because once they got to that point, they then kind of had a pullback. And then versus the S&P 500, which had 62% of its funds being positive, but many of those funds for that whole period there had not had a very strong relative strength, and so they didn't have the same run. So the point is that, yep, we're still going to see pullbacks every now and then, but we're okay if we're outpacing the market by that much. We have to expect that sometimes those funds are going to have to kind of cool off. And so the same thing, so these are mid caps, exact same story here. Those areas that we were investing in, over 17%, those RSIs totally hit above 70, kind of completely hyperextended there. And then so we saw a pullback then of negative 1.3 in those same areas for just a shorter period of time. And then the same idea here is that those areas of great relative strength, over 70, only 36% of them were positive over that time of December 22nd to the 29th. And so again, because those areas of relative strength that had ran so far, nothing can go in a straight line forever. They kind of have to almost like regroup and have a period of time to kind of like cool off, and then they can kind of go on to hopefully meet new highs again. And then the same story here for the small caps. So small caps, although significantly outperformed, up 25% for that time period of the 22nd to the 29th. Again, only looking at those funds that had high RSIs that eventually reached 70 on the 22nd. Now they were down about 2.5%, but again, we're okay with that, having a 2.5% pullback when we were up, or in areas that could have been up to 25% over the long run, and then versus what the market did here. So you can see the market here was up a quarter versus we were down, but only up 7.2 versus 25. And so I just thought it was an interesting way of showing that we can kind of look at these. And so we expected that as we saw that RSI was becoming very extended, it's kind of like, how long are these going to be able to run for? So the good news though is, so we traded sideways and then we had some negative performance slightly over the last couple days. And so this is where we're able to look at and say, so are we starting to see sector rotation? Are we starting to see areas that were like super hot before that are not going to be as hot and new areas moving in? And the answer is likely for now that these RSI numbers, these relative strength numbers, they just kind of had to get trimmed back for a couple of days. And so I'm actually going to show you though where we are at with these funds specifically right now, because I think it's a helpful. So let's take a look here. So at one of our sector funds, so let's look at our innovative tech fund right now. And so what we're going to do, let's just take a look here. All right, so this bottom line here is going to be our relative strength number. Okay, so this is that number that we track. And so you can see, especially here, bring this over some, that RSI, which is down here. So here's our RSI number. So you can see, so this number here is going to be 70. So we hit above 70. We were actually pretty well above that. And you can see that as soon as we hit above 70 here, you can almost see that pullback then that we began to have over those last few trading days. Now we're well under 70 at 60, which is a much healthier number. And interestingly enough, that kind of corresponds with the fact that right now, XITK is up over 1% for the day. And so it's likely that what we saw in relative strength was just an overextension when we look at that specific fund. And so let's pull, I'm going to show you again the same thing in our mid-cap fund here. So same thing. And these are things that we're looking at every day, kind of tracking, trending, charting. And so here's our RSI number here. So you can see we were above 70%. And then pretty much as soon as we became overextended, we saw a little bit of a pullback there. And then we are now at 62 RSI, which is again well under that 70, which is again a much healthier number than being above 70. That 70% is kind of like once that happens, things kind of start to flash like, hey, we've really run hot. We're going to have to. And you can kind of see though how that's kind of happened. I mean, we had a really nice little run up. So to have a little bit of a pullback was certainly not at all unexpected. And again, today being up over 1% in that area after we had just a kind of couple days of consolidation and pulling back, very healthy within the market. And so these are things that I thought it was interesting though, just to be able to kind of show you live action. Hey, these are things that we look at. So when we're trying to determine, these are ways that also help us determine if a fund is still an appropriate healthy place to be, because right, we want to take what the market will give us. So that means we need to be in the right areas of the market, because we also want to avoid the areas that are going to be laggards for us. So we can look at relative strength and be able to tell, is this negative performance we're seeing because RSI is really beginning to deteriorate and the relative strength is much lower now than the broad-based market, or had we just run hot for so long that relative strength needs to normalize for a couple of days so that we can continue on and hit new highs again. And so those are things that that we look at. So right now, let's just talk about daily. So daily asset level investment election here. So as you can see, domestic equities is still far and away the best place to be. So right now, having the most buy signals is going to be mid-cap growth, small-cap growth, and large-cap. So 1, 2, and 3. And then technology, consumer cyclicals, those are going to be the areas of greatest strength as subsectors beneath those broad-based asset classes. And so that's really where we have kind of steered our allocations for now, because we want to be in the areas of strength. We're going to avoid these areas of weakness until they begin to shift and begin to show increasing relative strength. So right now, relative strength, highest relative strength, lowest relative strength. One thing that I'm not sure if I mentioned last week, but we did take a small international position. So we did take a 10% international because we've really seen international come from, international was literally all the way at the bottom and it's just flown kind of up. And so we did take a position in that, and it's done very well. And so we will continue to watch that, because remember, the idea is that we want to find those areas of the market that are strengthening and appear that they will continue to strengthen, then avoid those areas of weakness that will likely for the time period continue to weaken. And so that's kind of what we look at with that. And so this is a short trading week. Obviously there's a half day in the market tomorrow, and then Friday the market will be closed. And so I really just wanted to spend some time, kind of, number one, I'm going to do this from time to time, where if I see something or we talk about something that I think would be beneficial for you to see, I want to be able to share that kind of with you. Parts of our process, we'll be going through that and eventually working in other topics as well. So within the market right now, it's quite obvious that Dolly is telling us from relative strength that domestic equities looks very, very strong right now. And so that's where we have heavy allocations. And for now, we'll just continue to follow that math and rules. And hopefully as we move into 2021, those remain the same as these areas kind of begin to rotate through and kind of begin to arm wrestle each other, and new winners are declared as being strong versus weak. We'll make those portfolio changes as needed. So that's what I wanted to get into today. Again, I thank you for joining us. I thank you kind of for sticking with us this whole time as we have undertaken this video project. We're excited about it. I'm going to be bringing a whole lot of new stuff to you in the new year, including some podcasts, webcasts, doing some continuing education type stuff that we'll do live and then record for you. So really looking forward to that. I wish you and your family the best. I hope you have a very happy new year, and we will see you next week in 2021. Have a great day.